All right, let's talk about Kohl's stock because it just pulled off something wild on Wall Street. Kohl's, the department store chain, saw its stock price literally explode recently, jumping over 100% in a single day before cooling down a bit to still be up around 36%. Think about that. It doubled its value in hours. This kind of jump is so extreme it even triggered trading halts multiple times. But here's the kicker. There was no big company news, no huge announcement from Kohl's that caused this. So what the heck happened? I'll give you the full details on this at the very end of the video, so make sure you watch until the end. This massive sudden surge in coal stock wasn't about the company doing fantastic. Instead, it was driven by something called meme stock mania. Remember GameStop or AMC from a few years ago? This is that same energy. Here's the simple breakdown. People betting against the stock. A huge number of shares in Kohl's were shorted. This means a lot of investors were betting that Kohl's stock price would go down. In fact, around 49 to 63% of all available Kohl shares were being bet against. When more than 8% of a company's shares are shorted, that's usually considered a lot. The short squeeze. When a stock that's heavily bet against suddenly starts rising, the people who bet against it get nervous. To limit their potential losses, they start buying shares to close their bets. This buying, in turn, pushes the stock price even higher, forcing more short sellers to buy, creating a dizzying upward spiral. It's like a snowball rolling downhill, getting bigger and faster. Social media hype. This whole movement was fueled by chatter on social media platforms like Reddit, especially the Wall Street Bets Forum, and StockTwits. Retail investors, which are everyday people like you and me, coordinated their buying efforts, making Kohl's the top trending topic on these platforms. The message count for Kohl's on StockTwits jumped an incredible 7,800% in just 24 hours. Insane trading volume. On Tuesday, July 22nd, 2025, the trading volume for Kohl's was off the charts. Early in the session, nearly all of Kohl's available shares were traded, about 104 million out of 112 million total shares. This kind of volume is unheard of for a typical day and shows just how many people were piling in. This isn't about the company doing better, it's about the pure power of online communities and market mechanics pushing the stock around. Now, you might think a stock jumping like this means the company's doing great, right? Not so fast. The real story behind Kohl's is actually quite different. Despite the stock's wild ride, Kohl's is a struggling retailer with significant challenges. Here's a quick look at their recent performance and issues. Sales decline. In the most recent fiscal quarter, which ended May 11th, Kohl's saw its sales drop by about 4%. For the full year, they expect sales from existing stores to fall even further by about 4 to 6%. That's not a sign of a thriving business. Leadership troubles. Kohl's has had a revolving door of CEOs. The previous CEO, Ashley Buchanan, was fired after only a few months because he allegedly directed the company to engage in contracts with a vendor where he had undisclosed personal conflicts of interest. This lack of stable leadership makes it incredibly tough to execute any long-term turnaround plan. Dividend cut. Earlier this year, Kohl's slashed its quarterly dividend by a whopping 75%. This is usually a red flag, indicating a company might not be confident in its future cash flow. Analyst outlook. Professional analysts on Wall Street are mostly bearish on Kohl's. Many have sell ratings on the stock, and their average price targets are much lower than where the stock is currently trading. For example, one analyst firm even gave it a price target of just $4. Goldman Sachs, while increasing its price target slightly from $5 to $7, still kept a sell rating. This shows a big disconnect between the recent stock jump and what the experts think about the company's actual health. Tariffs. Like many retailers, Kohl's is facing higher costs due to new tariffs. While some hope tariffs might reduce competition from cheap imports, they also hurt consumers' budgets and make pricing difficult for Kohl's. Financial health. The company's current ratio is around 1.1. This number tells you how easily the company can pay its immediate bills. A number this low means Kohl's might have trouble paying its bills, especially if its cash flow is negative. Kohl's is in the early stages of a turnaround with some strategic initiatives like integrating Sephora beauty shops and focusing on proprietary brands. They've also been emphasizing value and style for back to school items under $10. While these efforts are positive steps, they haven't consistently boosted sales yet, and the digital business has actually declined. So, is this a real comeback for Kohl's or just a temporary thrill ride? We're about to find out what makes these meme stocks so tricky. The meme stock phenomenon thrives on short term speculation rather than solid financial performance. It's about momentum and social media buzz. Retail traders, which are everyday people like you and me, are trying to gamify the market using online coordination to create massive price swings. Some arguments for Kohl's a few weeks back included its large real estate holdings, valued at about $9 billion, with over 1,100 owned stores. Some thought this real estate could be unlocked to add value. However, the reality is that actually selling off or subleasing these properties can be very difficult. And this asset play idea didn't really work out for other retailers like Macy's. Also, bondholders were reportedly betting against the stock to protect their investments in case of bankruptcy. A behavioral finance expert even described the skyrocketing prices of stocks like Kohl's as a mini bubble, similar to the internet bubble of the late 1990s. These rallies are inherently fragile and often followed by sharp corrections once the hype fades. Now for the most important part. What should you do about all this? I'll break down the smart money move, and it might surprise you. First, understand that investing in retail stocks can be really challenging. Consumer tastes change fast, and retailers can stumble. When you compare a struggling company like Kohl's to a strong performer like Costco, the difference is clear. Costco has a massive company value of about $420 billion and a loyal customer base with renewal rates around 90%, even after raising membership fees. Their operating income grew by over 15%. Costco's stock has also soared by over 200% in the last 5 years, easily beating the overall market. While Costco's stock price is a bit higher compared to its earnings, it's a well-run company. On the other hand, Kohl's has seen its stock price lose over 55% in the last 5 years. It's a classic case of paying a premium for a high-quality business versus trying to pick up a struggling one on the cheap. So, here's the actionable advice. First, understand the risk. Meme stocks are incredibly volatile. They can go up incredibly fast, but they can crash just as quickly. GameStop stock price went from under $5 to over $120 in just 4 weeks in 2021, but it hasn't come close to that high since then. Don't chase price. As one expert put it, I never chase price. The best opportunities allow me to enter on my terms, not when I'm feeling pressured. Don't feel pressured to jump into these stocks just because they're making headlines. Speculative money only. If you absolutely have to play this game, use only fun money, money you can afford to lose completely. This is highly speculative trading, not long-term investing. Focus on fundamentals. For most of your investments, look for companies with strong fundamentals, consistent growth, stable leadership, and healthy financials. Companies like Lockheed Martin and General Motors, while not always making flashy headlines, are building long-term value with strong backlogs and strategic innovations. In summary, Kohl's stock surge is a classic example of social media-fueled meme stock frenzy and a short squeeze, not an improvement in the company's business. While it might be exciting to watch, the company still faces significant financial and leadership challenges. These types of rallies are usually unsustainable, and chasing them can lead to significant losses. For most investors, sticking to companies with strong, proven fundamentals is a far smarter long-term strategy. If you enjoyed this breakdown, hit that like button, subscribe to the channel for more straight talk on the markets, and don't forget to ring that notification bell so you don't miss our next video.